We'll get started now. Thank you everyone for joining once again. My name is Kathleen Jaworski. I work on the Channels and Technology team here at Acción, and we are happy to be participating in CFI's FI 2020 week with this presentation on digital field applications. So I'm going to go through the presentation, and I encourage you all to hold your questions and type them into the questions box that you have in your dashboard, and we will address those at the end. On the line we also have with us some representatives from Musoni and OBS, two of our partner institutions. So if you do have questions specifically related to those institutions, I might put you guys on the spot at the end and allow the participants to ask direct questions to you. So today we're going to go over objectives for conducting this study, and I'll give a brief overview of the three participating financial institutions, as well as go into a bit of a conceptual framework of how a digital field application works, and then the objectives that each of the institutions had for implementing such an application, what results they achieved, and then some of the best practices and lessons learned throughout the process, and finally we'll end with a bit of a discussion on the business case as well. So starting with objectives for conducting the study. The Channels and Technology team has a mission and a vision to leverage innovative channels and technologies to support achieving financial inclusion in a sustainable and effective manner. And what that means is we provide advisory services to Acción's partner MFIs as well as fintech companies to help them look at new ways of reducing costs while still reaching the target market that Acción seeks to serve in its goal to build up financial inclusion. So where DFAs come in is very much on the cost-saving side of an institution. A DFA is, the formal definition builds up from the notion of mobility, mobile applications, and these are software applications designed to run on phones or tablets, and can centrally manage multiple devices and data. That is, users can log into a central data repository to perform various business tasks, which can include collecting, retrieving, analyzing data, assisting business users on providing customer service, performing checks on a business process, or automating functions such as deposit collection and loan application. So you can see that DFAs have a lot of potential to reduce costs and increase efficiency for microfinance banks, but we've seen in the market that the use of DFAs is still very nascent. And what we found is that this slow adoption is linked to a bit of a chicken and egg problem in that nobody really wants to take the first step without a proven business case and without a clear understanding of how implementing a DFA will impact the organization, the staff, and the clients. So when we initially set out to do this study, we looked to find within our partner institutions examples of institutions that had implemented or were looking to implement, and we found that none were really ready or none were at this stage. So we opened up the market to a broader search and worked with 3 institutions over 8 months to chart the implementation process and evaluate the results. And a big objective of the study was just to provide some evidence and some numbers behind whether this makes sense for institutions. So for the institutions participating, here you can see a field officer at Ujjivan in India was one of the 3. We specifically chose institutions of varying sizes to better compare and contrast processes and results. Of course, digitizing services can show a lot of impact, whether at a large or a small institution, but large institutions often require more complicated implementation, so we did want to be able to compare. As you can see from this chart, the three institutions spanned the globe from India to Serbia and Kenya. Client base, Ujjivan has 2.2 million clients compared to Musoni's 15,000. So again, a good range here. The 500 million, 68 million, and 23 million are the loan portfolio size. Ujjivan and Opportunity Bank, Serbia, focus on individual lending, whereas Musoni has a group lending model. And the DFA implementations began in 2014, and 2012. So we started this process back in November of last year in identifying the institutions, and each chose a different provider given on what was available in the market and what their needs were as well. So at Ujjivan, Ujjivan chose to work with R2, which is a specialized DFA provider, and R2 provides its DFA as part of its customer relationship management solution, really managing the entire customer relationship for its clients. So R2 worked with Ujjivan to develop an Android app paired with a web portal, and this functioned in offline and online mode. Whereas OBS used its core banking service provider, Asseco, and created a combination of a custom-built app that directly integrated to a credit scoring module. Musoni, similarly to Ujjivan, created an app that paired with a web portal using an in-house IT team that had split off to become a third-party provider. So again, Musoni Services was very familiar with Musoni, the MFI, and that enabled it to really understand very well what the needs were. So again, for financial institutions, we're going to go a bit over the conceptual framework. DFAs are used usually for a specific business purpose, such as collecting, analyzing data, providing customer service, providing checks, or automating functions. Now, each of the three institutions that we worked with chose to focus on the loan application process. And the components of the DFA that are then created include the application itself, which is installed on either a tablet or a smartphone, and can enable any of these functions that you see here. And this connects either online or offline to the DFA backend. And the software integration allows the application to speak to the core banking system, alternatively also connect to the credit bureau, as we saw with OBS. This connected directly. And at Ujjivan and Musoni, another component was the web portal. So the application connected through the backend to the web portal allowed any information that the loan officers are collecting in the field to be then directly visible and accessible for staff at the branch to be able to start processing this loan, conducting reporting functions, or credit committee reviews. So to summarize, the full DFA solution comprises the mobile application, the web portal, and the backend database. The mobile applications that we've seen most commonly are built on Google Android and run on tablets or mobile phones. And the loan officer or whoever field staff can collect this data. And then the web portal is managed by the office-based staff. The web portal and mobile application connect to the back end, and ideally this connects to the core banking system, but not always. So I do encourage you, each DFA, each institution designed its DFA according to its own business needs. So I encourage you to look at the individual case studies that we have published to go into detail on the way this layout looks for each institution. This is sort of a genericized view. Now, if the DFA is not integrated to the core banking system, you may see complications such as mismatches in customer data and security risks associated with storing data in two systems. So without integration, the full potential of DFAs may not be achieved. And a key point here to emphasize is that each institution chose to enable their DFA to operate both in online and offline mode so that data could be captured in areas with no data signal. This allowed staff activities and client services to continue without interruption, but this does introduce an additional complication in that the DFA must be able to store core banking system data and data captured in the field locally, and then synchronize once they're online. So this entails storing a subset of data locally on the device. And initially, early adopters of DFA often operated in online mode only. So the choice to also operate in offline mode really increases the functionality of the solution, but again, does require additional attention in the design and the integration. So we'll talk a little bit now about the objectives of each institution. Across all three, a common theme was to reduce turnaround time from the beginning of the loan application to the dispersing of the funds, and associated with that to improve loan officer productivity, enable them to turn around more loans more quickly, and in that way also serve customers more efficiently and with better service. Now, OBS had a slightly different objective, given that OBS very much has a strong agricultural focus. And so their main goal was to improve customer service by being able to provide real-time decisions in the field for agricultural loans, and this would also reduce the costs of servicing these loans. Now, to enable them to do that with their risk teams, they set out pre-specified limits within which the system would be allowed to make these decisions for certain parameters that it could operate. And again, the goals of reducing turnaround time and increasing productivity achieve key business objectives for the organizations, but also improve customer service as well, with less time spent collecting documents and a smoother application process. So for Musoni, the DFA was designed to replace the paper forms previously used for client and group registration, which again, an entire group of clients for group loans, everyone collecting paper forms is a very lengthy process. The DFA was intended to streamline and make this more transparent. And for Ujjivan, there was an additional incentive to adopt the DFA because they chose to focus on their SME clients, which they were targeting individual clients that were new to the institution, unlike SME clients, the majority of whom had graduated from their group lending operations. So reaching out to new clients required more rigorous credit analysis tools and processes to ensure quality and control, and again, that was a major impetus behind the choice to implement the DFA. So you can see some of the results here, but I'm going to get into those a bit later. The one thing I did want to highlight as well is that Musoni, a secondary goal was to digitize 100% of client data to be able to then create a credit scoring database. And so this they were also able to achieve. This slide here is just to show that it's very important, and each institution mapped out the requirements that they wanted to achieve with the DFA, and so therefore configured the DFA to their business needs. For example, Musoni wanted to eliminate paperwork from group loans, whereas OBS wanted to offer an immediate credit decision in the field. So in this next section, I'll highlight a few key results and then talk about the benefits that accrued to clients as well as the institutions. For the institutions, benefits can be divided into cost savings, efficiency gains, and the knock-on positive benefits. So I'll go through each of those in turn. But first, results were, as you can see, overwhelmingly positive, confirming our hypotheses. In general, you can say it's kind of intuitive to think that digitizing processes will lead to more efficient solutions. But again, the main goal of this study was to put some numbers behind those basic common sense assumptions. So most importantly for the clients, the DFA saved them time and money. This mainly manifested through the need for fewer KYC documents, fewer times to show up and make photocopies, the transit costs that are associated with that. So very important that we see a lot of benefits for the clients. This also translated into loan officer caseload increased by 134% at Ujjivan and 68% at Musoni. Important to note that this increase cannot be 100% attributed to the DFA, but other processes that work to supplement the efficiencies gained, including better marketing, better organizational processes, any number of changes. But in our business case, we did set out to identify within each institution what could be attributed to the DFA itself. So along with loan officer caseload increased, the turnaround time did decrease as well. An average decrease from 21 to 10 days for 68% of loans at Ujjivan, and 38% of clients received their loans within 7 days. Musoni dropped from 72 to 6 hours. The main reason why Musoni's turnaround time is so much shorter is that they were founded from the beginning as a 100% digital MFI. So the DFA digitized their back-end processes, whereas the client-facing processes, loans had been dispersed through M-Pesa from the beginning. So those turnaround times are shorter. At Ujjivan, the credit bureau check is only valid for, I believe, 7 days, and therefore if the loan application process went beyond that, it required initiating a second credit check, which lengthened the turnaround time and also increased costs by having to request 2 or multiple credit checks. Regardless, we see strong decrease in turnaround time for both, and OBS was also to achieve its goal of delivering an in-the-field decision for 80% of the targeted agricultural loans. And also all 3 institutions, in terms of the business case, were able to break even within 12 to 24 months, depending on how you amortize the costs. So a little bit more on the client benefits. Again, as I mentioned, The main benefit is that it enables clients to save time and money, and with this, a much more convenient process. And again, with a broad definition and understanding of financial inclusion, this idea of convenient services is very important. The clients were subjected to or didn't have to handle more visits, multiple visits with loan officers if all the documents are correctly collected the first time around. The DFA reduced the risk of human error, which again was a major factor in the multiple visits. And clients also noted that with the improved controls, there was less risk of ghost accounts or potential fraud, along with being notified sooner whether they were they in fact approved for a loan or not. Even the faster notification of rejection, which may seem like a negative, allows the client and the institution to move on and not continue in a process that's not going to result in success. And finally, but not least, the emotional benefits that we observed were quite strong as well. Clients expressed pride at being served by cutting-edge technology. They really felt that this showed that the institutions cared about them and were willing to invest time and effort at serving them with the best solutions available in the market. And these emotional benefits are, I think, equally important to the convenience and the saving of time and money. And also, in general, helps foster a sense of confidence and strength in the relationship between the clients and the MFIs. For example, at Musoni, the clients were able to get real-time answers in the initial group lending meeting and not have to wait as long, and again, just really felt that they were getting much better service. Here we have a loan officer in the field with a Musoni client. And moving a bit on to the institutional benefits, again, a key benefit we see here is cost savings. This shows up in reduced data entry effort. You'd require fewer staff typing in information. Previously, that was collected on paper forms. This also means you need fewer computers for typing in this information. You don't need the paper to print. You don't need the storage to deal with all that paper that is generated. All of the costs associated with visiting the client multiple times in the field, if you can get that down to one visit, those costs are reduced. Again, I mentioned at Ujjivan the need for multiple credit bureau lookups was reduced if you can fit the entire process into the validity of one credit bureau check. On the efficiency side, again, reducing turnaround time, automated decision making, stronger controls at point of data capture reduced the incidence of human error, which again necessitates multiple visits. This also allowed the officers to increase their geographic coverage and reach more clients, which again is an important point for the client service. And finally, for the institutions, along with all the cost savings and increased efficiency, the DFA really enabled future capacity and future ability to use this information that they're gathering. MFIs really sit on a gold mine of information, especially institutions that have these long-term relationships with clients. If they're able to capture the data that covers this relationship for years and years, this is really something that will enable them to perform better social performance monitoring, and also better credit scoring capability. You can also develop tools to assist loan officers with the analysis, again, decreasing the time it takes and improving the quality. Another interesting application is the ability to use GPS data to monitor client locations and staff locations. Many MFIs expressed interest in being able to make sure their staff at any given point are where they say they are and where they are supposed to be. In addition, this could also be used to plan out more efficient routes. Again, as I mentioned, reduced human error allows for better compliance and less chance of fraud. Over time, also, you could reduce the portfolio at risk by tighter controls and better analysis of the applications, more quickly weeding out bad quality applications and focusing on those of good quality. Again, the DFA really established for the institutions that we looked at their reputation as a market innovator with clients as well as with in the field more generally, and improve staff retention as well. One of the fears at times is, again, staff themselves must be willing and able to adopt the technology and use it effectively. This, as we'll see in the best practices and lessons learned, is one of the key points in designing a DFA. If that is done well and staff do adopt the technology, it improves their working conditions. They're able to serve their clients more quickly and more effectively, and also we did see that staff also felt pride in being able to carry this device into the field and offer it and be a savvy user of this technology. So moving on to best practices and lessons learned, we found several best practices around the planning and implementation stage, and I cannot emphasize this enough, but the time spent in the beginning to really analyze the requirements, the business requirements that the institution wants the DFA to be able to meet, and then also taking a hard look at your current business processes and mapping them out to understand, are there areas here that themselves are maybe not operating at 100%? Is this the optimal way to organize our business? Is this what we want to digitize? We find that it is not a good idea to just take whatever system you have and dump it into a digital format. As I like this quote from Bill Gates, which the first rule of any technology used in a business is that automation applied to an efficient operation will magnify the efficiency. The second is that automation applied to an inefficient operation will magnify the inefficiency. So this just goes to show that it's important to make sure what you're automating makes sense. Otherwise, you will just create a solution that's not 100% what it could be. And where we see this in an interesting way is at OBS, in looking at their loan application process for agricultural loans, identified a few data entry points where they weren't contributing as much or weren't as predictive in in generating a decision, and so they chose to eliminate those fields when migrating to the DFA. So rather than just take over a whole laundry list of items, really taking a clear, hard look at what is needed to take that opportunity to streamline. And along with that, it's very important, of course, to monitor pilot results before scaling and really get a sense of what's working and what can be tweaked to work better before you scale out that solution. And in that process, very key to get buy-in from staff at all levels, from the loan officers to the branch staff to the upper management. Does the solution work for everyone? If not, where are the areas where we can improve? So we saw that with the 3 institutions in their development process for the DFA involving loan officers in testing, really seeing, can they use this? Is it too slow? What in the fields can we adjust to make this process less, to have less friction? And again, in doing that testing and in having that sort of participatory development process, you're able to identify super users or staff who are very enthusiastic about the solution and really leverage them to drive out the learnings and use them to train others, have a demonstration effect, which also was a key best practice. On the technology side, as I mentioned, it was very important to assess realistically the connectivity environment and decide, does that mean that we want to be able to operate in offline mode? At what point? How does that then translate into linking the application to the backend and the web portal? All of the decisions that needed to be made around that really just required the MFI to think carefully and plan out. In addition, deciding where to store data, obviously of great importance when institutions are digitizing more and more of their back-end processes as well as their financial services, making sure that consumers are protected and the institution is protected. Both from the physical device itself, how can you keep that secure, and the data as well. And also of consideration are the areas where the loan officer is working safe enough to have them carry around pieces of equipment that may be of value. This, again, is an important question to ask. We found only in perhaps the certain urban areas that this may be a danger. In other cases, again, the cachet of the officer carrying the device may offset that security risk. So the answer there is that it does depend, and it's worth looking into. Of course, you need to test out the devices and the operating systems, make decisions on whether or not what level of device to purchase or to rent. How long does the battery last, for example, is something that we found varied and did make a difference. And again, working closely with the solution providers in the development stage, as I mentioned, to really test out the kinks and make sure that not only does the solution function technically, but also all the staff are able to use it effectively. So I'm going to move on to the final section of the business case and hopefully leave a few minutes at the end for questions. Again, if you joined late and you do have questions, please feel free to type them into the questions box, and we will get to them shortly. So as I mentioned at the beginning, one of the major rationales for this study was to develop uh, a business case. And we did this at each institution, working with them during the implementation and planning process to help them understand more about the impact the DFA was having, um, and what components needed to go in there to understand, to have a good sense going in of what the costs would be and what the time and level of effort for staff and ongoing maintenance, etc. So the main reason for building the business case, or at least performing some kind of feasibility analysis before embarking on implementing, is to avoid some of these common problems that you see here, um, which can result in low adoption or even abandonment of the solution. And really, a lot of these problems can be avoided by having a clear understanding going in of what the implementation will entail. So for example, low adoption can be caused by misunderstanding the actual business need, and therefore implementing a solution that doesn't meet that need for the users or the organization, or underestimating the need for proper training of your staff, who then don't adopt because they don't understand how or why. This then can lead to lack of impact if users are not able to use the solution. If the field officers don't understand how, then it will not function as it is intended. On the technology side, of course, understanding how reliable network communications are, understanding the need for integration between the DFA and enterprise applications such as the core banking, or not having the proper hardware needed, etc. And all of these kind of issues can build up to sort of loss of engagement, lack of buy-in from staff who are critically needed to drive forward the necessary human resources, and all of this, of course, will translate into not being able to show a positive ROI. And therefore, to avoid these issues and to really ensure that the DFA is meeting your business objectives, as part of working with the three institutions and building the business case for each of them, what we then did was create a hypothetical case derived from averages of real numbers of the three institutions, because we felt that since Ujjivan, Musoni, and OBS all benefited from the business case tailored to their own institution, this could also be a useful tool for MFIs interested in implementing a DFA themselves. So we looked at, on the cost side, the CapEx costs involved in buying or building the platform and implementing it, acquiring the devices and integrating them. On the OpEx side, building in platform support and connectivity, ensuring that a percentage of your help desk time will go to addressing issues with the DFA and making sure that's built into the cost. And then on the benefits side, trying to put numbers behind what it means to reduce data entry staff. And in the three cases here, this did not mean termination of those staff, but reallocating them to more higher productive uses of their time. Again, reducing stationary and other costs, and how does higher caseload translate into increased revenue, and what does that look like? So you can see here the inputs that we created for this hypothetical MFI in terms of number of clients, roughly 50,000, average loan size 750, with these other inputs here, then we calculated out the capital expenditures, which, again, according to the inputs that we provided, were about 180,000, along with on annual operating expenses of about 32. And you can see the breakdown of where these costs, the relative proportions of these costs. Obviously, the highest for capital expenditure is the implementation itself. This also includes the human resources, both internal staff and then also the time and effort of the solution providers. And critically on the operational side, to build in the fact that you will have ongoing costs. And within the model, and I do encourage, so maybe a bit of background on that. In publishing this case study, there are actually 5 documents associated. One is a consolidated case of the results of the 3 institutions and more broadly the general findings and best practices. And along with that, there are 3 individual case studies that focus specifically on the experiences of Ujjivan, OBS, and Musoni. Each also has the business case of that institution built into those studies. And then finally, we also developed this Excel tool for institutions to look at these hypotheticals and then adjust them to their own institution's numbers and then play with what implementation would look like for them. So we see that with this hypothetical MFI, total cost savings were around 150,000 and increased revenue was about 315,000. And you can see the breakdown here from salary savings, paper reduction, storage reduction, increased caseload allows officers to service more loans, again, increasing revenue. So for the institutions, for the 3 that we studied, they actually all achieved a positive ROI in year 1. Again, depending on how you amortize the costs. This, of course, will not always be the case, which again goes back to the need to really tailor the business case and make sure that the solution that you're adopting fits the specific business needs of your institution. And we do hope that this can be a useful tool, and that along with the case and the positive findings, institutions will be encouraged to investigate and consider possible applications themselves, and also then share back those lessons. We would love to see a broader conversation across the industry on, are there other institutions using DFAs? What has their experience been? What are the challenges that they've faced, and how have they addressed them? We have found in the year since starting this study, a number of Acción partner MFIs are also in the process now of implementing DFAs, which our team is assisting them in thinking through the strategy and implementation of that. And we hope, again, to see that other institutions are also taking this on. So with that, I am going to open it up to questions, with a final slide here of OBS, also a client in the field here in Serbia, and again a quote from the managing director there. So thank you everyone for your attention, and I do hope that, let's see here, I'm looking in the chat box, and it's teeny tiny, so Neil, could you perhaps assist with how to view this better?
Oh, Caitlin, can you hear me?
Yes, I can hear you.
Caitlin?
Okay.
Yep.
So I can see the question here from Owen. I would love to hear more about the applicability of new alternative credit scoring mechanisms or tools that these DFAs may have enabled. Great question, Owen. Thank you for that. So alternative credit scoring is a very a topic that we are closely following and are very interested in seeing institutions adopt. One example of a venture lab investee company is First Access in Kenya, which uses mobile phone data to attempt to then build out an alternative score for clients who may not have a traditional credit score and enable MFIs to then use that for their loan assessment decisions. What we've found is that there are a lot of great models out there that are trying to do this, and many are having difficulty in getting access to that alternative data in terms of how to structure those agreements with the telcos and how to ensure that customers are understanding that what they're willing to share. There's an interesting report just put out by the Omidyar network looking at this topic as well. Another example in Chile is Destacame, which is also using utility payments to create a score for these formerly invisible, credit invisible clients. The idea of Destacame is individuals will create an account and then link their utility payments to that account so that they will be visible and chart a record going forward. As far as I understand, it does not capture past information, which is something that we would love to see, of utilizing individuals' lifetime histories of successfully paying rent on time, successfully paying utilities, and translating that into scores. But for first access, that information can be captured on tablets as well. So this could be, in theory, perfectly integrated to a DFA. Oh, and does that answer part of your question? Does anyone else have any questions? And also, Neil, could we give the floor perhaps to Cameron here, Cameron Goldie Scott, or Rajko, if either would like to comment briefly on their institution's their perspective of the study?
Oh. Hello?
Yes, we can hear you. Go ahead.
Oh, okay, I'm just checking. So I'm Raiko in front of OBS, and I basically went through the experience of setting up this application and investigating options, doing a business analysis, and rolling the application, rolling the project. Beside me, also my colleague Slobodan, who run the project in the lifetime phase later. A short comment to the business case presented. It's very nice combined all together. So basically, although three case studies have some differences, but all comments are actually making a good generic case, as you have presented in the last slide. So I find that very interesting. I'm a bit skeptical regarding a business case starting from the scratch. It's very hard to um, to find some key point in a situation where there is no data, no experience. But I'm not experienced with that part, so it's just a commenting. So if you have some more detailed question, please.
Okay, I'm going to unmute everyone if anyone has specific questions for Rajko, or again, Cameron is from Musoni as well. And Cameron, if you'd like to say anything, please feel free to chime in.
Unmuted.
Cameron, you actually have to unmute yourself.
Hello, can you hear me? Cameron here.
Yes, we can hear you. Thank you.
Sorry about that. I tried unmuting myself earlier and it didn't work, so I was waiting to be unmuted, but it seems to be fine now. Yeah, so thank you, Catalina. Really interesting presentation. Really nice to see all of the case studies around each other. And I think we obviously very much agree with kind of the analysis, the business case, and the assessments you've made. One thing I would just add on to it is that we, at least at Musoni, we see the Musoni app, so that the DFA that we built, as just one stepping stone in kind of the journey of technology in microfinance. And we see the real advantages of it when you combine it with all of the other components that we've introduced. So obviously having a kind of robust MIS is absolutely key before you can even start thinking about some of these other additions to it. But then the integration with mobile money allowed us to have a lot of advantages in terms of automatic processing of payments before we started trying to digitalize the loan application workflows and the client registration workflows. And once we'd gone completely cashless, it was only then that we started thinking, okay, well, where are the other bits of or areas of inefficiency in the organization? And that's when we started thinking about the very large amount of paperwork and the large amount of time processing paper at the credit committee and making loan decisions based on all of these kind of piles of reports. And that's we worked on DFA, then we started looking where next, and we started automating lending decisions. We piloted with the company you mentioned called First Access to do actual credit scoring, and we're now about to launch a mobile app, so giving some of this information directly to the end clients, things like account statements, balances, things like that. So for us, it's just a step in the broader journey of technology in microfinance, rather than the end game, I guess. It's worth mentioning that.
Yeah, that's a great point. Thank you for sharing that. It is an important point to note that the DFAs that we looked at here were very narrowly focused on loan application processing, and as Cameron mentions, much additional functionality can be built onto them, and likewise, the data that is collected over time can be used for other purposes as well. So very well noted that this is just a starting point, and much more can be built on once organizations have tested it out and gotten a sense for how to build the basic solution. We do have a question here from Elise. How do you deal with issues of information privacy when utilizing GPS applications with clients? Great question. In the three cases here, they were not yet using GPS functionality to track clients or staff. More what we heard from them was interest in tracking staff. But you highlight an important point of that going forward, institutions do need to pay careful attention and spend time thinking about how, in a field with greater digital financial services, are we protecting clients? What do we need to do? With Smart Campaign, Channels and Technology has done work in adapting the client protection principles for digital financial services. So that is definitely something that going forward institutions need to pay careful attention to. So thank you for that question, and thank you, Cameron, for your comments. Did you want to share anything else, or does anyone else have any other questions? All right, well, I want to be mindful of time. It is after 11. So with that, I will thank Cameron and Rajko very much for your comments, and thank you all very much for attending. I hope this was useful and informative, and I hope you attend many other FI 2020 events this week. So thank you and have a great day.
Thank you, Kathleen. Really appreciate it.
Thank you.